historical analysis in 2023, Hino current ratio is decreased to 1.8 times from 2.12 times in 2020 and 1 time in 2021, but still relatively stable. This shows that company have an ability to meet its short-term obligation. Failure to do this will result fail in business. In terms of historical analysis, the current and quick ratio for Hino demonstrate varying trend over the past 3 years. These fluctuations suggest potential shift in liquidity management practice or change in the company financial position over time. For competitive analysis, comparing Hino ratio to industry benchmark reveal consistent underperformance. Past 3 years, Hino current and quick ratio were lower than the industry average. This indicates that Hino may face more significant challenge in meeting short-term obligation and managing liquidity compared to its industry peers. Thus, there's clear need for Hino to address this shortcoming to enhance its financial competitiveness within the industry.
There are 3 implications based on the liquidity ratio current performance of the company. Firstly is possible cash flow concern. This could be indicate cash flow issue of inefficient use of resource in managing short-term debts. If this trend continues, the company may struggle to pay debts, cover operational expenses, or take advantage of immediate investment opportunities. Secondly is risk of liquidity problems, which is company may face a higher risk of liquidity constraint. This means it may have trouble covering immediate liabilities without relying on inventory. Lastly is competitive disadvantage, which is consistently lagging behind industry. Liquidity ratios can put the company at a competitive disadvantage. As a result, sustaining market position and achieving long-term profitability and growth goals can be challenging for the company.
Using question number 2.1, which is how to conduct an analysis of the asset management ratio for Samsung Electronics Co. Limited and its subsidiaries utilizing the provided financial statement. To find an analysis of the asset management ratio for Samsung Electronics Co. Limited, we need to use the ratio analysis for asset management ratio. To find the inventory turnover, we need to use the formula of COGS divided to average or closing inventories. In 2022, for Samsung Electronics, 145,501,003 divided to 39,956,410 equal to 3.64 times. Different to 2023, 138,110,266 divided to 39,566,134 equal to 3.49 times. So the analysis for inventory turnover is Samsung Electronics in 2023 has a lower inventory turnover compared to Samsung Electronics in 2022, which has highest the ratio. To find the average collection period, we need to use the formula of account receivables divide credit sales divide 360. In 2022, for Samsung Electronics, 27,349,373 divided to 145,101,003 divided 360 equal to 67.66 days. Different for 2023. 28,058,213 divided to 138,110,000. 2066 divide 360 equal to 733.13 days. The analysis of the average collection period is Samsung in 2023. Samsung Electronics take longer time than 2022 to collect debt. Next is non-current assets turnover. The formula we use is sales divided to net non-current asset. In 2022, 231 million 396,319 divided to 176 million 58,804 equal to 1.31 times. Different in 2023, 198 million 247,856 divided to 199 million 39,464 equal to 0.99 times. The analysis for non-current assets turnover is Samsung Electronics has lower non-current assets turnover in 2023 compared to 2022. And last but not least, total assets turnover, sales divided to total assets, where 2022 231 million 396,000 and 319 divided to 343 million 325,000 and 656 equal to 0.67 times. Different in 2023, where 198 million 247,000 and 856 divided 349 million 53,672 equal to 0.56 times. The analysis of total assets turnover in Samsung Electronics in 2023 has lower total assets compared to Samsung Electronics in 2022. That's all from me. Thank you.
These are the optimal course of action that Samsung should pursue based on its performance. Starting with inventory turnover, Samsung could try to apply a streamlined inventory management, which means to conduct a throughout analysis of inventory levels and adjust ordering process to align with demand forecast more accurately. Implement just-in-time inventory practices to reduce excess stock and minimize holding costs will also help. Next, diversity product portfolio, which is to explore opportunities to diversity the product portfolio to capture new markets or to cater to changing consumer preference. This could involve introducing innovative products or expanding into adjacent industries to stimulate demand and increase sales velocity. Second is collection time of debt. Based on the latest performance of Samsung, it takes longer time to collect debt. Thus, Samsung should implement review credit policies, which means evaluate the company credit policies to ensure they strike the right balance between attracting customers and mitigating credit risk. Tighten credit terms for customers with a history of late payments while offering incentive for early settlement to encourage prompt payment. Other than that, offer a flexible payment option will also help, which is diversify payment options to accommodate customer preference and improve cash flow. Consider offering discount for early payments, installment plans, or alternative payments methods such as electronic transfers or mobile wallets to expedite debt collections. Third is non-current assets, where Samsung should implement an asset utilization analysis, which is to conduct a detailed analysis of non-current assets to identify underutilized or idle assets. Explore opportunities to optimize asset utilization through better allocation, repurposing, or disposal of assets that are not generating sufficient returns. Next is strategic capital expenditure planning, which is Samsung can try to develop a strategic capital expenditure plan that prioritizes investment in high-yield projects with the potential to generate significant returns. Focus on projects that align with the company's long-term growth strategy and have a positive impact on a non-current assets turnover. This will help to increase the non-current assets of the company. And lastly is the total assets, where Samsung could use portfolio optimization as an action to help increase the total assets. It means to evaluate the company portfolio of assets and consider divesting underperforming or non-core assets to free up capital and refocus resources on higher growth opportunities. This could involve selling off assets that are no longer aligned with the company's strategic objective or market condition. Next, Samsung could try financial management, which Samsung can implement a prudent financial management practices to optimize the use of existing assets and improve overall financing performance. This could involve financing debt, renegotiating contracts, or restructuring operations to enhance profitability and maximize the value of assets.
And question 3.1, explain the significance of debt and profitability ratio in financial analysis. Debt ratio are a tool used by investors to assess the degree of financial risk involved in making an investment in a firm. A corporation that exhibits a high debt to equity ratio or debt ratio may be highly leveraged, rendering it susceptible to fluctuations in interest rates or economic downturns. And for the profitability ratios, investors use profitability ratio to gauge the overall health and potential return on investment of a company. A company with strong profitability ratio, such as high return on investment or net profit margin, is often seen as more attractive because it indicates efficient operation and potential growth. That's all for me. Thank you.
Investor and creditor use debt and profitability ratio as key indicators to assess a company financial health and performance. Debt ratios such as debt to equity ratio and interest coverage ratio help assess its ability to meet debt obligation, providing insight into financial risk. Investors look for companies that have less debt value than companies that have a lot of debt value to reduce risk and ensure they get multiple return on the investment. Additionally, profitability ratios such as return on equity measure a company's ability to generate profit relative to investment and sale. Higher profitability ratio indicate efficient operation and the potential for attractive return, making the company more attractive to investors. Creditors also rely on profitability ratio to measure company ability to generate profit to cover debt obligation, while debt ratio help assess repayment capacity.